Financial institutions rarely collapse because they lack data. The surface of modern finance is polished, with precise ratios, compliance checklists, and daily reporting dashboards. But under pressure, that surface shatters, revealing a highly complex, often tangled wiring system beneath. The central paradox of financial risk is that catastrophe almost never originates from a total absence of information. The models are usually running. The metrics are usually calculated. Instead, failure incubates in the gaps between those metrics. A warning sign flashes in one department, while another holds the missing context. Information is delayed, poorly aggregated, or entirely disconnected from the authority required to act on it. Many professionals reduce risk management to a static list of measurement models, regulatory capital ratios, and internal audit checklists. This assumes that quantifying an exposure is the exact same thing as controlling it. A formal risk framework exists on paper. It is the math and the policy. Financial risk architecture, however, is the lived, operational anatomy of the institution. It is how the organization actually behaves when faced with uncertainty, high-velocity speed, and intense market pressure. To build a system capable of surviving extreme stress, we have to examine how exposure is actually quantified, map the hidden interdependencies between those exposures, and install a strict governance logic that forces early intervention. Any institution seeking durable strength must treat financial risk as a core engineering problem. It is the structural foundation of survival, not a peripheral compliance exercise completed after the commercial decisions are made. Value at risk, or VAR, compresses market exposure into a daily loss threshold under normal conditions. But during crises, historical correlations break down, pushing losses beyond this threshold. Expected shortfall captures this reality by calculating the average of extreme tail losses. We turn now to the second pillar, credit risk. Measuring this exposure involves modeling the specific mechanisms of loss, from a borrower's deteriorating credit quality to the eventual recovery value of their collateral. Expected loss multiplies the probability of default, exposure at default, and loss given default. But when conditions worsen, weak borrowers aggressively draw down credit lines, surging exposure at default. Simultaneously, the collateral backing those loans collapses in value, spiking the loss given default. This distinguishes expected loss from unexpected loss. Expected loss is the routine cost of doing business, covered by pricing and standard provisions. Unexpected loss is the severe variance that directly consumes the institution's capital reserves. Relying on isolated formulas calibrated during calm periods creates a mathematical illusion of safety. It blinds management to the compounding forces that emerge in extremes. The third pillar is liquidity risk. Assessing this requires separating funding liquidity, the ability to access new cash and liabilities, from market liquidity, which is the ability to convert assets into cash quickly, at predictable prices, and in meaningful size. This contractual maturity ladder organizes incoming and outgoing cash flows into perfectly balanced time buckets. But under stress, behavioral reality takes over. Incoming lines dry up while corporate demand deposits flee, and outflow bars surge into the immediate time buckets, crushing the balance. An institution can report an immaculate liquidity ratio at the end of the month, while carrying severe, unmapped fragility on a Tuesday afternoon. Human panic and timing mismatches effortlessly destroy legal assumptions. The interdependency trap occurs when frameworks assume market, credit, and liquidity risks exist in disconnected compartments. In reality, they are highly dynamic, converting into one another and acting as transmission channels for systemic failure. Consider a sharp decline in asset prices. The shock registers as a market risk event, but triggers immediate margin calls. As counterparties demand cash, the market event instantly mutates into severe liquidity strain, forcing the institution into fire sales. These fire sales flood the sector, depressing prices and deepening market losses in a self-reinforcing feedback loop. This volatility exposes credit weakness, the probability of default jumps, and the entire network becomes a contagion of systemic failure. A single shock cascades through every balance sheet category. Institutions that monitor isolated metrics are blind to these compounding interactions, proving why an integrated architecture is strictly superior to a fragmented framework. Ultimately, calculating risk means nothing if no one is obligated to act on the math. Measurement without governance produces information with no force. Governance begins with risk appetite. This is the strategic boundary set by the board of directors, establishing the maximum acceptable capital consumption or earnings volatility the institution will tolerate. Risk tolerance translates that broad appetite into operational reality. It establishes the hard desk limits for traders and the soft early warning triggers for portfolio managers. But the most common point of structural failure is ambiguous ownership. If the Treasury assumes risk is monitoring, and risk assumes the trading desk owns it, a massive hazard grows quietly in the gap between them. To close these gaps, architecture requires strictly mapped escalation pathways. When limits breach, emergency protocols bypass the normal hierarchy. A direct escalation line forces critical data past slow committee loops, delivering it straight to accountable executives to activate contingency funding. True risk architecture is not about printing thicker policy manuals. It is about designing decision rights, authority, and accountability so that executives can act decisively when time is the scarcest resource. The ultimate test of a financial risk system is not its ability to generate elegant dashboards during stable, profitable quarters. Its purpose is to improve human judgment under speed, pressure, and uncertainty. This is why advanced institutions utilize reverse stress testing. Instead of running a standard historical scenario, management starts at a hypothetical state of total institutional insolvency and works backward to locate the exact breakpoint that would cause it. We do not run these tests to validate our models. We run them to break them. We hunt for specific market conditions, concentrated exposures, or liquidity gaps where the firm's strategic ambition outpaces its control capacity. A robust risk architecture does not exist to oppose strategic growth, geographic expansion, or product innovation. It exists to discipline it. By forcing clear ownership and mapping exact tolerances, sound architecture forces an institution to answer one defining question. Is your new revenue genuinely building durable enterprise value, or are you merely borrowing time from your future resilience?